Hey everybody, Tim Doehrmann back with you again to continue our videos on taxes in retirement. Now today, I'm going to discuss what a Roth conversion is and if you should or should not be doing it. I'm going to try to frame the mindset of how we try to help people think about them, whether it's our clients or prospect or just anybody out there listening to this video. And then we're going to give you a real world example in dollars and cents of how they can help save a lot of money in retirement if done properly. So far, we've talked a little bit about the problem that having most or all of your money in a tax-deferred account like a 401k and or an IRA or a 403b, any type of pre-tax account can create a retirement tax bomb when, of course, it comes time to withdraw that money, whether you need that money to live on or if you wait until required minimum distributions or RMDs, when of course you have to take the money out. It's going to come out at regular income tax rates or our 7-bracket ordinary income tax rates that we've discussed before. I want to talk to you about how to diffuse this retirement tax bomb and reduce lifetime tax liability by using Roth IRA conversions. So what is a Roth IRA conversion? Well, a Roth IRA conversion involves taking pre-tax money from a traditional IRA and converting that money to after-tax money in a Roth IRA. Now, why would you want to do this? Well, withdrawals from a Roth IRA, both principal or the amount that you actually invested, and the earnings are going to be tax and penalty free if you are 59 and a half or older, as long as you've had the account open at least 5 years. So all your investments, if one goes from 10 to 100 and you followed the 2 previous rules, it's going to come out tax free. So that's really good, right? 10 to 100, tax free at 100, that's great. So Roths are usually our best accounts if we can get money into them. And of course, there are no required minimum distributions from Roth IRAs, so the account can just continue to grow until you need it. Now, a Roth conversion is considered income in the year of the conversion, and you're going to need to pay taxes on that income based, of course, like I said, on your current income tax rates. So by paying taxes now, we're basically setting up or leveling out and reducing your lifetime tax liabilities. You are basically paying taxes now on your pre-tax retirement account to avoid paying higher taxes later. That's the whole point of a Roth conversion. Now, at the moment, with income tax rates at historically low levels, filling up lower income tax brackets with Roth IRA conversions can be a great tax planning strategy and one that we are recommending and use quite frequently at my firm. Now, I know what you're thinking. Why would you want to pay taxes before it's absolutely necessary? Well, let's go through an example and we'll see if it does or does not make sense for you. Let's say we've got $100,000 in an IRA, and if we leave it there, that tax bill is just going to be kicked down the road because we're deferring it until the time at the very latest that we need to take it out at a required minimum distribution age, or maybe we have to pull it out a few years before that, right? And let's say that the tax rate we're going to have on one side, we're going to leave it $100,000 in there, and then we're going to say on the other side, we're going to go ahead and convert that pre-tax money to a Roth. And so let's say on that our tax rate is 25%, okay? I know that's not a threshold or one of the bracket levels, but it makes my math simple. Now, if we choose to take that money out of the IRA and we convert it to a Roth, we're gonna have to pay that tax bill on the way over to the Roth, right? So that $100,000 minus the tax bill would mean that we're gonna end up with $75,000 in the Roth IRA. So again, the question is, should we do that or should we not do that? Well, we can convert whatever we want. A conversion is not the same as a contribution. There's always a lot of confusion around that. But a conversion, you can convert whatever amount that you want. There are no income limits. There's no age limits. There's nothing. Everybody listening to this can convert whatever amount they want from their pre-tax traditional IRA, but that's not the question, is it? The question is, should we? Let's take a look at an example of how we should frame this. So let's say we're going to jump forward 10 years and see if this was a good idea or a bad idea. And in both situations, the part that we left the $100,000 in the pre-tax account and the part over here, the $75,000, let's say it's 10 years later and both accounts have doubled, right? Well, we would take that for sure, right? If we didn't do the Roth conversion, the amount of the $100,000 goes to $200,000. So that's good, right? And the $75,000 that we already converted went to $150,000. So 10 years later, the difference in the account value is $50,000. But remember, it's about how much of your money you get to keep after you pay off the IRS. So when it comes time to spend the money from the IRA, we still have to pay a tax bill, right? Well, if the tax rate stays exactly the same, we said it was 25% 10 years ago, and now we're going to say it's still 25% today. So that means that we're going to end up with $150,000 in both the part that we converted in the Roth IRA and in the pre-tax accounts. So let's go back to the original question. Do we defer our tax bill or do we not defer our tax bill? Well, it's all a function of where tax rates are, right? It's kind of like an arbitrage. Well, if your tax rates do not change, then it's a wash. But here's how we need to think about this. If most of your money is sitting in an IRA or a 401k or any type of pre-tax account, you're basically making the bet that you think tax rates are going to go down because you've chosen not to pay your tax bill today. So you're deferring it to a later date, hoping that there's a lesser rate or maybe even that it stays the same. And of course, you're probably still working, so this is probably fine because you're in your peak earning years or close to it. But if you are retired or close to it, you better start paying attention to this. But let me ask you this. Do you think it's likely that our tax rates, which are at historically low rates and have been coming down for decades, do you think they're going to go up or down in the future? Well, my industry is literally calling what we have going on right now a tax sale. And almost everyone I've asked has said that they think it's more likely that our rates are going to go up from here rather than down. And of course, I would agree with that. And if you think that your rates are going to that our tax rates are going to go up and 80% of your money is in an IRA or a pre-tax account, then your thoughts and your beliefs are not aligned with your money. You're just going to end up paying Uncle Sam more in taxes down the road. And while everyone's retirement situation is unique, if you have tax deferred assets, 401ks or IRAs, then there's probably a very good chance that you should be doing Roth conversions. If not now, probably when you do retire in your gap years. And again, your gap years are the years between retirement and required minimum distributions, which keeps getting pushed back, right? Which is great. It gives us more years for tax planning. And next, I'm going to show you in dollars and cents how Roth conversions can add a great deal of tax savings if done properly.